Elon Musk is calling Trump's tax bill a disgusting abomination. Meanwhile, Fox Business hails it as the economy's next rocket fuel. The Atlantic warned it's a windfall for the wealthy disguised as reform. Listen, it's got everyone polarized and disagreeing. But one thing is a fact. The bill has passed. So for those of you that follow me for business and especially real estate, what does this ultimately mean for you? I've been keeping an eye on Trump's big, beautiful bill for a while now, and it's undergone a lot of revisions. No bill makes it through Congress without changes.
I'm just a bill.
You can love it or you can hate it, but the truth is the legislative process is built on negotiation. Additions, subtractions, last-minute trades, and sometimes it strengthens the bill and at other times it waters it down. Either way, deals have to be made to get things passed. Investors get it, idealists struggle with it, but it is the nature of the game. So today I'm gonna go over the 7 biggest changes that were actually made in the bill so that you can get fully caught up to date on what the final signed version looks like right now. Now listen, if the information is valuable to you, I would appreciate it if you'd hit that like button, and if you'd like to see more videos from me or about our current economics, make sure that you subscribe. Number 1, the TCJA extension was scaled back, right? Trump originally proposed making the 2017 Tax Cuts and Jobs Act permanent, but that meant lowering personal income tax brackets, a double standard deduction, and favorable treatment of small businesses that would ultimately get locked in forever. But Congress pushed back. Instead of permanency, lawmakers extended most TCJA provisions only through 2032. What that means is that by the end of the decade, we're looking at another round of tax reform battles. Now, why did Congress hold back? Listen, permanent cuts come with steep price tags, and the bill was already projected to add trillions to the national debt. But by adding a sunset clause, moderates were able to sidestep budget reconciliation rules and basically reduce long-term projections. Listen, here's the bottom line. You only get 7 more years of the current tax breaks, but you don't assume that they're gonna stick around without a fight after that. Number 2, capital gains exemption threshold was raised, but then it was narrowed. The original draft of the bill proposed increasing capital gains exemptions to encourage investing. It sounds great on paper, especially in the game of real estate that I'm in, or basically for crypto investors, but critics argued it's overwhelmingly favoring the top 1%. So Congress decided to insert income-based thresholds. So now only households earning under $400,000 annually qualify for the full exemption. Listen, this compromise still allows everyday investors to benefit, especially those using 1031 exchanges and long-term investment strategies, but it closes the door on ultra-wealthy families using capital gains as a very big tax shelter. In practical terms, this change won't really impact the average person's flipping a rental property. But listen, if you're selling millions of dollars in assets, expect to pay more than you would have under the original draft. Number 3, let's talk about the eliminated income tax on tips and overtime pay. One of the surprise wins in this bill was the elimination of income tax on tips and overtime pay, up to a point, however, right? The final law actually exempts up to $12,500 on tips and overtime, or $25,000 for joint filers. This is a direct benefit to blue-collar workers, service industry employees, basically anyone putting in long hours to make ends meet. What changes, though, is there's now a phase out, right? Once your household income surpasses $150,000 personally or $300,000 jointly, this benefit begins to disappear. Still, for millions of Americans, this is real take-home pay, and it's no longer getting skimmed off by the IRS. Hey, sorry to interrupt the video, real quick. How cool would it be if you had a multi-millionaire step into your shoes and basically say, if I were you, this is what I would do to become a millionaire as quickly as possible? If you'd like for me and my team to give you a free game plan on step-by-step exactly what I would do if I were you, click the link below, get a free game plan, let's go. All right, change number 4. Let's talk about qualified business income deductions that were made permanent, but then got narrowed down a little bit, right? This deduction, introduced in the original TCJA, allowed qualified pass-through business like LLCs and sole proprietors to deduct 20% of their business income. Trump wanted to keep it, and Congress agreed, but then they added stricter phase-in limits and adjusted thresholds to ensure that it doesn't overly favor high earners or certain industries. You kind of see a little bit what Congress is doing here. They don't want to favor the super wealthy. They basically want to make sure that the average everyday American gets benefited as much as possible, and that we're not supplying tax breaks to the super wealthy, right? This final version keeps the deduction permanent, which is a huge win for small business owners. However, the list of what counts as qualified business income, it just got tighter, right? Professional services, consulting, and even real estate brokerages may find themselves scrutinized more heavily under the new IRS guidelines than they were before. Change number 5, SALT deduction cap was raised, but it wasn't removed. Trump's original plan was to eliminate the $10,000 cap on state and local taxes, called SALT. That was a big deal for residents of high tax states like New York and California, but eliminating it altogether proved too costly and definitely controversial. So instead, Congress decided to raise the cap to $25,000 for joint filers, but only for up to 5 years. This change was definitely a nod to moderate lawmakers from high tax states who face pressure from constituents. It softens the blow, but it doesn't fully satisfy those who wanted a full repeal. And because it's temporary, it's a political football that could get kicked around again in 2029. Number 6, estate tax threshold was compromised. Another area where the bill was scaled back, the estate tax. Trump proposed raising the exemption from roughly $13.6 million to $25 million per person. Congress settled on $15 million per individual and $30 million per couple, with inflation indexing. Like several other provisions, the move was pitched as a way to protect family farms and small businesses from being unfairly taxed, but critics say that it primarily benefits the ultra-wealthy. So by capping the exemption lower and adding a sunset, Congress gave ground to both sides of the aisle without completely derailing the bill. And number 7, there was a surprise last-minute inclusion on gambling tax, like super random, but basically in a last-minute addition, lawmakers tacked on an extra 1% of federal excise tax on online gambling winnings over $5,000. This provision wasn't in any of the early drafts, but it emerged during final negotiations as a way to raise revenue without touching the core tax cuts. Basically, it targets online betting platforms, which have seen explosive growth in recent years. Supporters say it's a smart way to tax a booming industry. Opponents argue that it unfairly punishes casual gamblers and adds complexity to reporting. Either way, it's now part of the final bill, and it's going to impact everyone from fantasy sports players to crypto casino users. Trump has now officially signed the bill into law. So over the coming months, the IRS and Treasury, they're going to begin issuing implementation guidelines. And basically, we're going to start seeing a ripple of the effects of all of this through the economy. Businesses are going to recalculate their deductions. I'm excited about that one. Workers will see changes in their paychecks. Investors are going to reevaluate their strategies, which, by the way, I've been doing a lot of in the last several months because a lot has changed in the economy. Listen, whether this bill creates the economic boom that Trump promised or not, it remains to be seen. But one thing is certain, the tax landscape in America, it's shifted once again. And by the way, for entrepreneurs, definitely for the better. And how you adapt to this, it's definitely gonna make all the difference. So for those of you that follow me for business and especially real estate, what does this ultimately mean for you? Well, interest rates are still high and there's rumors that they're gonna drop in the second half of the year. It's keeping prices kind of soft right now, and it's actually good news if you're looking to buy. But once rates start coming down again, many experts believe that that's going to happen the second half of this year. Demand is going to spike, and prices are likely going to surge again. So if this tax bill fuels stronger economic growth and inflation ticks up even just a little bit, real estate values could climb pretty fast. This is why we're already seeing investors make moves. They're getting in now while there's still definitely time to lock in deals at today's prices because they know that they can always refinance their interest rates into something lower. But buying before the next rate drop, it's not just about timing the market. It's about positioning yourself for maximum upside, while real estate is one of the few assets that tends to rise with inflation, meaning it doesn't just survive a volatile economy, it thrives in it. Like it's when we actually make the most money. Like we had a lot of instability during the pandemic, and guess what? Real estate prices shot up almost $100,000 per home on average. Now, leaving your money in a savings account right now, that is a guaranteed loss of time on your money, right? With interest rates on savings barely keeping pace with inflation, if at all, your dollars are basically losing buying power every single year. But real estate, it's a hard asset. And especially when inflation is high, real estate is the asset you want to hold. It holds up its value, and on top of that, it produces income as well as tax savings. And it adjusts with the market. And it's why more people are looking to move their cash into property instead of letting it just sit in a bank account or just a 401k or an IRA. This is ultimately why for the last 20 years, regardless of what's happening in the economy, especially a volatile one, I go to real estate, I invest in real estate. And if you want to join forces with me and you want to see the way I'm investing in real estate, if you want hands-free passive approaches to get in the game, click the link below, connect with my team, ask for a free game plan. We'll show you some options. There's always a way to invest in real estate, whether you do have money or don't. There's definitely people with 401ks and IRAs that are looking for way better returns because they know it's not going to be enough for retirement. And real estate can definitely deliver that if done right. And on the other hand, there's people that are starting out in real estate the way I did. Literally, you believe in real estate, but you don't have any cash, and there's a way for you to get started as well. So again, click the link below, request a free game plan. Let me show you how to get it done.